Your dream home opens easier with us. PNB Housing Finance.
Welcome back. You're watching Closing Trades right here on ET Now. Ganeshram Jayaraman joins in. He's head institutional equities at Spark Capital Advisors to give his perspective on the markets. So Ganeshram, good to have you in the show. What's your broad view? I mean, we're making fresh lows really for the market. Went past 7,200. Now the market has recovered. That's largely due to the bounce back in the Dow Jones futures and what the European markets are doing. But in this uncertainty, in this volatility, what is your position?
Good afternoon. Yeah, I think it's easy to get despondent in this market, right? Quite a bit of fatigue that we are seeing in the market. But what we are saying is, in some form, this is the darkest hour before sunrise. Is pretty much the hour before sunrise. So what we are actually telling investors is, India is going through a transition phase, a transient phase where the earlier cycles drivers are weakening and the newer cycles drivers are getting formed in place. So this is an intermediate phase where you are seeing both at crossroads. It's important to distance yourself a little bit from all the pain in the market in the last month and a half and step aside and kind of see the fact that the drivers for long-term structural growth is very much intact. What we are seeing is the earlier cycles growth, which was led by inflation, which was fiscal deficit fueled. It led to a pickup in rural consumption. It led to real estate, in some form, even a bubble getting created there, and currency depreciation, which led to exporters doing well. So these three are in some form weakening mode, and we are seeing the impact of that leading to a flattish earnings profile. But what is improving clearly is fiscal deficit improvement leading to government spend, both at the center and state. We are seeing savings pick up, which I think it bodes very well for how we see things take shape for going forward. And we're also seeing fledgling signs, early signs of discretionary consumption, especially on the urban side, come up.
Right.
Our view is also that rural is kind of bottoming out.
Sure.
So in this whole in mixed environment, I think it's important to look at the positives and say that.
Yeah. No, Ganesh, my question is, it's a very interesting time to have a conference of sorts. What's the dialogue to the clients? Go out and selectively buy, or just stay on the sidelines, because it's not really an India-specific problem, and the sector that is there is right in the middle or the center of all the badgering that is happening in the markets.
Right. Clearly, this is possibly the biggest barometer of what's happening, right? Always is. So we are having close to 25 listed banks and NBFCs, apart from another 15 unlisted banks and NBFCs in this conference. The mood is obviously one of a lot of challenges in the environment, especially in this quarter's results, and the clouds surrounding the pickup in NPAs which have come up. How much more, how much longer can it last is the question on everyone's mind, and that's coming out in the questions in the meetings. So I think it's critical at this stage to distinguish between structurally challenged NPAs and cyclically challenged NPAs. So there are lots of assets which are true colors of which are coming out now, which possibly should have come out earlier as well, but these are not going to get rectified anytime soon. But we will definitely see operationally more cyclically challenged NPAs actually improving. I think in this environment it's important to distinguish between the two, select the right kind of banks and NBFCs who will benefit out of the cyclical improvement which we are going to see. And that's pretty much the question which we want to have answered in this conference.
So, well, Ganesh, the point is that is easier said than done, right? The idea is everybody who wants to buy the right kind of banks and right kind of NBFCs. Let's nail it down to banks. The right kind of banks, perception-wise, the right kind of banks are not cheap. They are still available at these times, available northwards of 3 times book in most cases. A Yes Bank could be cheaper, but otherwise most of the others are. And the others which are available cheap, we don't know how much further the downside could be because of the kind of numbers that have come out in the commentary, which hasn't been too positive as well, especially for the PSU banks. So what do you do?
There is an in-between pack between the larger, newer private sector banks and the PSU banks. Those are the regional SME banks. and that's where you see actually an improvement in performance to be likely. They don't have the large chunky infra exposures which the larger PSU banks have, and nor are they as costly as the new gen private banks. So the big upside we see is actually both on asset quality growth and on margins, and on asset quality, asset mix between bonds and loans is actually the regional SME banks.
Okay. Let's give our viewers some food for thought, some points to ponder before we get some names out of you as well. What are the favorites out of the conference that is attending? But Poonam Sani from our research desk is joining in right now to tell us about all that's happened, the kind of stats that really raise an eyebrow or two when it comes to investors in the financial space, the banking space in particular. Poonam, let's try and make it nice and quick. What are the statistics that made you raise your eyebrows as well?
Of course, it is asset quality, Neeraj, and because of that, the kind of losses that this entire banking system, the banks have been reporting so far. Look at the PNB, one of the biggest banks in terms within the entire PSU banking space, one of the biggest banks in terms of its loan book and deposit book size, and they also have reported loss before tax during this quarter, along with Central Bank of India, Syndicate Bank, Allahabad Bank, Dena Bank, IOB. All these banks have gone ahead and reported loss this quarter. This is the reason, if you see at the PSU banking index as well, it is down nearly 27% YTD. Most of the banks are down anywhere between 20 to 40% just in 2016 itself. If you look at the market cap versus the gross NPA itself of these banks, if market cap of these banks is far lesser than the kind of gross NPAs that these banks have been reporting. The jump in the gross NPAs has been anywhere between around 20 to as high as 50% just in one single quarter coming in from these banks, and all these banks are reporting gross NPAs anywhere to the extent of as high as 8 to 9%. For instance, just a PNB, its GNPAs are as high as around 10%. If you calculate even the restructured assets, their stressed loans is nearly at 17%. So the kind of stress that these banks are reporting on account of the exposure to infra, steel, and the stressed sectors of the economy, and of course RBI asking the banks in fact to go ahead and recognize the stress, is leading these banks to take higher hit in terms of the provisions and also report asset quality stress. There is more downside in terms of the asset quality stress. We do expect further kind of NPAs being reported over the next couple of quarters as well from the entire banking system, and that is likely to still keep the entire PSU banking space and also some of the private banking space would be under pressure because of this. It's a long-term improvement or long-term positive because the banks are going to start recognizing now the stress, but in the near to medium term, yes, the pain is still likely to continue.
That it is, and that is essentially the problem. Poonam, thanks for that. And you know, Ganesh, before we let you go, understand you are the conference to attend as well, but that's the question. You spoke about that in-between space. The problem with a lot of these investments that one want to make in the financial spaces, you don't know how much the pain could extend itself. You know, 2 months ago, nobody would have thought that at ICICI at 250, there will be so much pain, but it's corrected another 20% from those levels. SBI at 200 was a great buy, it is at 160 now. So that is the problem right now. Where do you pick and choose? Give out the house view of Spark, the banking names or the NBFC names that you are advising your clients to buy into.
So surely, I think, see, some of the restructured assets turning NPAs, see, some of these banks have been showing disastrous numbers for now, not just 1-2 quarters. Yeah, obviously, the scale has just changed this quarter, but for the last 3 or 4 years, this pain was coming. It was all showing up as restructured assets, not as NPAs, but that's exactly the point. You know, you invest in a bank not with just how the NPA numbers are looking, but with how the loan book is looking. So clearly, for now 5 years, we've been saying PSU banks are structurally challenged. We have been calling it a decade of distress for them. So yeah, they are not buys still. We still think challenges are out there and quite a bit from them. Even some of the private banks are there. I don't think I will be wanting to take names, but clearly will be showing stress in that pack as well. So it's going to be very specific names within the financials pack. On them, it's important we go overweight, because these stocks have also not given material returns in the last 12 months, though they've delivered consistent performance. So their ROE is increased, which means they are now a notch below their long-term average on price-to-book multiples. So that gives the important point. So in our model portfolio, we are overweight still on financials, but clearly the nature of stocks that we have in that space are very different to the ones which are showing the brunt of the pain at this point in time.
Okay. We wish you all the best, and hopefully a lot of these stocks that people buy into do yield good results over the course of the next 12 to 24 months. Ganeshram Jayaraman, Head of Institutional Equities at Spark Capital Advisors, thanks so much and all the best with the remainder of the conference.